Hi guys, and welcome to our webinar. This is CLIQ company. My name is Olga, and today we are going to talk about absolutely non-standard technique in the trading. And let me remind you that our webinar is interactive, so you can leave your comments or ask questions, and we will be happy, our team will be happy to answer them within our webinar. So, the topic of our webinar is trading technique. Absolutely non-standard. And some of you might think that this is very dangerous, the way that you are proposing us to do. And actually, this technique breaks a lot of market rules. But the others will decide, it's a good way to stay in the market for a long time, or to be constantly in the market when something is going on there, something positive, of course, for the trader, and take a lot of market movements and a lot of market signals. So let's take a closer look at what we are going to discuss today. And today our focus, our attention is drawn to the risks in the trading, or rather how to avoid them as much as possible, as much as we can. Okay, so we all know when the trader says stop loss, these two words means that this is the order of closing your transaction with loss due to the fact that the market went against us. And it's some kind of hedge or saving, or actually the protection of your deposit. That's why we can't trade without it. But also the traders, especially in practice, will deal with so-called Murphy's Law. What is Murphy's Law? If somebody doesn't know, it's not a law of the market which we can and must follow. It's more than an epigram which says anything that can go wrong will go wrong. And of course it's a joke, but it happens very often in the market. And a lot of traders will understand me, and I will give you such an example. Okay, it's a process of trading when you set up your stop loss, and the price reaches it and triggers it. That means your order closes with a loss, and after that, hello Murphy's Law. The price comes back to the previous direction, the same as we have already defined. And that is frustrating, because actually, in fact, we were right. Our prognosis of the market was correct. And this example is given to you to get you ready to the trading technique which we are going to discuss today. I will show you the technique of working without stop loss. And okay, you can hear that some of you will say, no, it's very dangerous. Somebody will say, it's a mess. It's wrong, nobody can do that. But actually, keep in mind that stop loss is just a technical element which can be replaced by another one. Namely, this element must be hedging and saving and protecting your deposit in any case. But in our case, it would be the pending orders. Or to be more exact, the opposite, pending orders. First things first. We are going to need an entry point, and let's take example on sell-through, just to make it easier for you. And it can be any signal. What we recommend you to do is to take middle-term and long-term signals. Just keep in mind that we are giving you not a trading strategy, we are giving you a trading technique which can be used in absolutely any trading strategy. Back to the entry points. Today, as an example, we will take an entry point of the simple pattern of the false breakouts. And you can use any time frame. To make it more visual and more global, we will take H4 or even daily. So we will consider examples on on daily time frame of the basic currency pair. So your actions must be following. First, set up your entry points. It would be example sell. Second, of course, open your transaction. Third, load any suitable take profit. It can be as big as you like or as small as you like. It's up to you to decide. If you're trading daily time frame, it's supposed to be big enough. 4 is the most important part of this process. At the price where your stop loss is supposed to be, you set up the opposite order, which is namely buy stop. Opposite pending order, which is a substitution of your stop loss. What are the main points of all our actions? In case, for example, your prognosis of the market movement was right, and the price reaches your take profit, of course your transaction will be closed with profit. And I will remind you that instead of stop loss, you're using pending order, opposite pending order by stop. In this case, when you have take profits, your buy order, your buy stop order must be deleted. It's not relevant anymore. That's why do it please immediately. But if your idea of selling was not quite right, quite correct, and it often happens that the market moves against you, against your sell order in our case, but it doesn't give you a signal for the opposite order, which is buy. Then what goes on? For example, market continues to move in the opposite direction of your order. You keep your sell position because you don't see relevant signal, confirmed signal for buy, and market moves closer and closer to your stop loss order. Here you are, in the end, you have a losing trade again. And we are going to give you an alternative. What to do in this case? I will remind you, in our case, instead of stop loss, we are using opposite pending order in the market if the market continues to go to the opposite direction and our buy is triggered, we are having a lock. And here also you will have some options and advantages. First, under certain circumstances, our risk will not grow further, which is very good. 2, you have time to analyze the situation in the market and understand what's the bigger priority, which direction is prevailing now. 3, the most important, you can wait until the next signal appears. If you get the signal for sell again, you close your buy with profit or with minimum loss that you have achieved, and you stay with the sell position as long as market gives you such an opportunity and let it grow. If you get signal for buy, only then you close your sell position and continue to keep your buy order as the priority movement of the market is now upward. This is the main point of this idea. You close your losing trade only in case of 100% of the confirmation of the priority of the opposite movement. Not as was mentioned before, as it was described before, when the trader is waiting for something to happen and has a losing trade in the end. Okay? Now we will talk about the further variations of our trading technique. And let's go to the starting point. So you remember, we have started from the availability of the market, the sell signal. And there is one more situation that trading often deals with. Actually, the shortage of the profits. You always, not always, let it be often, undertake the profit. I will explain. We set up take profit, the price triggers it, you have your profit, but the price continues to move in the same direction. For example, upwards or downwards, it doesn't matter. It depends on which direction you opened your trade. And the market doesn't give you a signal for the opposite order, so you can't enter the market. Why it happens? It happens because of high volatility. Sometimes market doesn't have a chance or time to form a good signal, a confirmed signal. That's why a lot of traders are losing this opportunity. To solve this problem, we are going to give you a variant. There are also such moments in the market when we can actually upgrade our trading technique. So we can do it right now. And so you are going to take the following actions to solve the previous problem and to upgrade your trading technique, which we are describing to you today. First, you define the entry points as it was before, and let's take the same example now. Second, you open your trade, of course. Third, you set up your take profit. It can be as big or as small as you like. Fourth, below the take profit, just a few pips lower, you plot pending order in the same direction, which in our case will be the sell stop. And not the only one. Actually, you set up the series of pending orders of sell stops. And as we are expecting the strong movement up to 200 or 300 pips, you plot as many pending orders as this distance requires. Number 5, and this is the main point in this process. At the price where you should set your stop loss, plot the opposite pending order, which in our case it's a buy stop, and guess what? It's not only one. It's also the series of buy stops with the fixed take profits, as you have previously defined or decided to set. And so on, you make a grid in both directions, which allows you not to lose any signal in the market movement if there is none. Actually, you take all the market movements. I think it's great. 6, get ready for the signal changes. Meaning, if initially you have a sell trade, but market gives you confirmed buy signal, you close your sell no matter what risk or what minus you have received, or whether it's losing or winning trade, and stay with the buy position. 7, you make the same setup of the orders, but now in the opposite direction, in the upward movement. Okay, let's summarize and underline the main points of this trading, absolutely unique trading technique. The most important thing for any trader, which this technique actually allows you to do, is to be constantly in the market, not without sitting in front of your monitor, but actually to be present in the market. Second, in fact, you just take all the market signals, even there is none of them. If the market doesn't give you a formed signal, you just take it. While the market just continues to move to follow its impulse, its momentum. 3, you close your losing trades only if you have the confirmation of the changing of the priority of the market movement, only 100%. Remember that. 4, thanks to the pending orders, you don't have to glue to your terminal all the time, and as you can see, there is also a possibility to work without stop loss by substituting this technical element with another one, which in our case is opposite pending order, of course with maximum security and safety to your deposit. And today we have looked at absolutely non-standard way of trading, and what is more important, it's working and gives you high profits. For its effective results, the only thing that we recommend you to do is your monitoring. Nevertheless, you have to monitor and control your trades in the process of the trading. And I would like to mention that all the all above-mentioned methods that we are presenting to you are practical technical methods used by our traders and our mentors. And of course, if you want to find out more, take our education courses. Should you wish, sign up for our online training on our website, which is www.cliqfx.com, and choose the best and suitable course for you, which you find there. From our side, we wish you the highest profit and have the best of luck in trading. It was CLIQ company. Thanks for staying with us. Thanks for sharing with us. Be in touch. Have a nice day.